This is Kaylin, Ty, and Caroline, and they are partners, and they're going to present first.
Okay, perfect. Good morning to you all. I believe it's morning, right? Where you guys are at?
Bright and early.
Excellent. All right, we'll go ahead. So Christine, you'll keep us honest with the time?
Yeah, I gotcha.
Okay, perfect.
Okay, cool. Thank you.
All right, Kaylin, whenever you're ready, you can share your screen with us.
Okay. Ready?
Whenever you're ready.
Okay. So the company that we chose to analyze is Berkshire Hathaway, and quite a great company. You guys should invest. So, an overview is that it's a multinational conglomerate holdings company, and it's led by the investor Warren Buffett, and its headquarters are in Omaha, Nebraska, and it's known or historically has derived most of its revenue from insurance and reinsurance companies, but also have a variety of other companies that are industry leading that are not financial businesses. And so a little bit of history is that it was first established as a textile manufacturing company, but then after World War I and the Great Depression, it didn't do so well. And so in 1962, I believe, Warren Buffett started investing, and in 1964, he bought the whole company over a dispute, and he felt that he could, so he just bought it. And so then the symbol is B. Well, we're analyzing the B stock, not the A stock. And so it's BRK.B, and the headquarters again are in Nebraska. Current share price per share is $197. It's a bit lower than what it is average, but then the target price is $388.92, which is a lot. But the recommendation is a long-term buy, and there's a float. Yeah. So the investment thesis, to put it simply, is in 3 points. It's that the company is stable. And so you can see this through their earnings during the 2008 global economic meltdown. And you don't see many companies that are able to sustain themselves throughout an economic meltdown, much less make revenue. But they were able to make, I believe, like $10 million. And this is because of their unique business model, an effective business model of always maintaining a cash flow. And so they're able to use the revenue derived mostly from insurance companies and other smaller businesses. And when the world is in a panic state, like the 2008 meltdown, they are able to use that cash flow to invest into other companies and buy shares at a lower price. Yeah. But then they also have a diverse portfolio of businesses. And so there's the Geico Insurance Company, Dairy Queen, the Benbridge Jeweler, McLean. And there's so many, and each year the list keeps going on. And so these are the reasons why it's a good long-term buy. And so again, like the Moat Analysis, the brand is basically, Warren Buffett is a very respected man, and he's known to have an extraordinary eye for things. And so he is, even if, how do you say it? He is basically the brand. And so he's a trusted person, and therefore the company is respected and trusted. And so then there's also the diverse businesses that I talked about just now, which allows them, so if one industry is not doing so well, other industries can help and cover up. But then the business model, again, is that they maintain a good cash flow, and that they're able to use that money that's running around and invest into other companies. And so revenue drivers would be the new assets from the report in 2007, the yearly report in 2017, sorry. Mm-hmm. And it's Pilot Flying J, which is a industry leading travel center. And they just, I believe like 40%, they just bought 40% of the company. There's Clayton Homes. And so Berkshire has 4 different types of, they consider 4 things when they're buying a company or buying stock from a company. And one is that it could either be self-standing investment, and that company will make revenue on its own and it'll be like profitable on its own. Or there's a bolt-in acquisition, which is when they buy companies that will help raise the revenue for one of their existing companies. And then there's intellectual property, and where they're buying mostly the people and not so much the people in the company and not so much the products. And then I forgot the last one. I'm sorry. But there's the last one. I forgot. But then, so yeah, those are the 4 types of acquisitions that they make. And then there's also one more, which is a potential revenue driver, and it's the recent government push for domestic manufacturing. And so Donald Trump has put tariffs on Chinese products, and in order to try and stimulate domestic production. And so this could lead to a rise in the railroad industry and the manufacturing industry that they're quite prominent in. Yeah, and so the financial analysis is that, as you can see it, they're profitable and they have liquidity. Oh, yeah.
Some investment risks. So the first major one is basically that when Warren Buffett leaves his position as CEO, that the company may be less stable or successful. Because as Kaylin before said, that Warren Buffett is basically the company. But even though this may be a risk, it's really unlikely to happen because first, he has 2 people that are very strong managers, Gregory Abel and Ajit Jain, who will be really good successors. So no matter who he chooses, they're both going to be really good and maintain the company well. And on top of that, he's also appointing 2 investment managers, Todd Coombs and Ted Welcher, whom both started as managing their hedge funds before joining this company. So even if he leaves his position as CEO of the company, it will still be really stable and successful. So another risk is that the company, because it has such a strong growth, that it may become a risk, because as the company continues to grow exponentially, it may cause destabilization because there has to be new rules and regulations that are put to place, and also like corruption might happen. So, however, this risk is really unlikely because although Berkshire Hathaway has strong growth, there are so many other companies that also have strong growth, like Amazon, Apple, Alibaba, Facebook, and they're always continuing to grow. So it's pretty unlikely that this company will become a monopoly and become destabilized because of it. So yeah. And the last 2 risks is that it may make a bad investment, or like its investment currently may suffer from operating problems. But even if this happens, because Berkshire Hathaway has such a strong model and it invests in so many different companies, and in the long run, it will be okay.
Thank you.
Excellent. All right. Well, thank you for the presentation. That was that's really good. So I hope your target price is accurate. I'm an owner. I've owned the B shares personally for a long time. So curious your thoughts. So kind of walk me through. You talked about kind of the succession plan, and that's obviously one of the big risks and the big unknowns. And it seems like the company's been thoughtful about that. When you look at the return drivers, it's such a diverse business. Are there certain parts that are more important than others in terms of driving revenues, or is it pretty balanced across? Kind of give me a sense for what the main revenue drivers are.
Right. So historically, in the past, it's been like insurance and reinsurance companies, and their reinsurance business has grown so big that it's like been named too big to fail almost. And so even though Warren Buffett doesn't like that, it's almost one of those companies in those industries. But recently, the manufacturing industry and their manufacturing businesses have stepped up, and I think last year they were the industry that created the most revenue for the company. But yeah, if I was to say the most important, if I had to choose one, it'd probably be insurance and reinsurance company.
And you're, when so you've got your valuation target at just under $400, with 300, call it $89. How much of that is predicated on growth within the existing businesses versus Berkshire going out and acquiring new businesses to add to the portfolio?
So how I did my valuation was I took the expanded PE ratio, so I believe it was like 2.3 times the price per earnings right now, and then I multiplied that by the projected yearly earnings per share of 2018, and so I think it's mostly based on what they have right now, and not so much on what they're going to acquire in the future.
Okay, so it's based on growth, internal organic growth. Because maybe this is kind of my last question. The challenge with Berkshire is when you get too big, making these small acquisitions, while they may be very good acquisitions, they don't do a lot to help to improve the bottom line, right? Because you really need to make big acquisitions to do that. So how do you feel kind of going forward? Is that starting to become more constrained? Their ability to buy companies and add on?
I don't necessarily think so, because if you look at their acquisitions of last year, there was this one company. Oh, I forgot the name again, but it's quite a small.
Go back to your slide if you want.
Sorry?
Do you have it on your slide?
No.
Okay.
Sorry. But it's quite a small company, and it hasn't. It's not very profitable, but they still bought it because of the intellectual property that they have. And so Warren Buffett has said many times that sometimes you have to trust the people more than the company and the numbers. And so he trusted the CEO and his management skills so that enough to buy the company. And so I don't believe that he is looking just at numbers and how to grow his company, but in investing in people and investing in knowledge. And so that's not really restraining their, I have to say, like, pool of acquisitions.
Okay, great. All right. Well, I think that's all the questions I have. Great job, guys.
Thank you. Okay, sorry, I have to get to class.
No worries. I know you guys have to go. Make sure you unshare. There you go. You got it.
Okay.
And then just close it out.
Oh, no, wait a sec.
Nope, you have to stop sharing. There you go.
Excellent.
Okay, thank you.
Perfect. Thank you.
Thank you so much.
Thank you.
All right, take care.
We'll be in contact.
Bye.
So they had school today, so they need to run.
Yeah. Saturday, huh?
Yeah, Saturday school.
Okay. Awesome.
So this is Faizan. Faizan is from Pakistan, and he'll be our next presenter.
Excellent. Faizan, well, good morning to you as well. Thanks for getting up early to participate in this and for finding us. So we'll kick it off to you if you want to share your screen and take it away.
Sure. Oh, wait. Okay, so I'm pitching a buy recommendation on Ascena Retail Group. It goes by the ticker ASNA on the New York Stock Exchange. And let's see what the company is. So Ascena is basically a specialty retail company. It owns and operates a portfolio of very popular retail brands that are focused on exclusively on women and girls. And it is the largest specialty retailer for women and girls. And in total, it has around 4,690 stores that are mostly in the US. and their brands are spread across their premium value fashion, plus fashion, and kids fashion segments. All right. So can you see like everything?
Yep.
Yep.
Sure. So the premium fashion segment is about 34% of sales, and it includes two brands, Ann Taylor and Loft, and both were bought by the acquisition of Ann Inc. And so they've got like 988 specialty stores and some franchises and e-commerce operations. And Ann Taylor and Loft are like two very popular brand names in the women's fashion space, and both companies have have very loyal customers. So the value fashion segment it contributes to about 30% of all sales. It includes two brands. It has Maurice's and Dress Barn. And these both brands offer like moderate to better quality apparel at reasonable prices, and hence the name value fashion. So they're focused on like special occasion, career, and casual fashion for women. So in total, they got like this segment has like 1734 stores and e-commerce operations and franchises. So the plus fashion is also about 21% of the total top line revenue. And the brands include Catherine's and Lane Bryant. They've got 1,000 stores. And like it is like exclusively for plus sized, like the women who like to wear plus sized apparel. And so it's the go-to place for them. So that's like a huge barrier of entry for other players who want to enter the plus size market. The kids fashion segment is about 15% of all sales. So it's exclusively for girls aged 6 to 12, and it is, again, highly popular among the demographic. And it consists of just one brand, Justice, and it has about 900 stores. All right, so let's look at the business. It's got a balanced revenue contribution, and it doesn't like to have all its eggs in one basket, and that's pretty good. So when you pull up the stock chart, like all you see is a sad story, because the stock price it's down 90% from its 2014 highs of $22 a share, and it can be seen that Ascena has literally been whacked in the last few years. So here's a short summary of what caused this sell-off. So basically, the stock was like way overvalued into 2014 at like 40 times earnings. That was a crazy valuation for a brick and mortar retail company. So first of all, it was overvalued, and secondly, tried to solve the problem when the stock price started to fall. They tried to solve the problem by buying Ann Inc. They were trying to buy themselves out, and they bought into an overpriced deal of $2.1 billion. And I'll discuss later why it was overpriced. So the third reason why the sell-off occurred was because the company disappointed expectations in 2015 with revenue that was below expectations, and they had actually a $236 million net loss. And even with the acquisition revenue boost, in 2016, net income was still negative, and it was like they lost $11 million. So the latest event that basically like hammered the stock was a huge impairment in the write-offs of their intangible assets and goodwill. And it hammered the stock to where it is right now at the $2 region. And this values the company at $396 million. Now, that's like irrational selling. Like, I believe that investors are like misunderstanding the situation due to short-sightedness. And I'd like to quote like an investor, a legendary investor, Michael J. Burry here, who says, where there's misunderstanding, there's often value. So let's see what the misunderstanding is. All right, so as a value investor, my job is to look for value in the most out of favor industries and sectors. And brick and mortar, like it has literally been whacked in the last few years. But here we have a company that has $6 billion, that does $6 billion a year in sales, and yet it is valued at $300 million. That's like 5% of its all sales. It is valued at $300 million. And it's got $100 million in free cash flow as for the most recent quarter. And it is basically the biggest specialty retail it is the third biggest specialty retail company in the US by revenue. So it should not be valued at $300 million. And it holds cash and cash equivalents of about $400 million. And which is like the company is trading at about less than its cash holdings, which is like quite very peculiar. So I think it's oversold. So the problem with the investors, I think, is that they're not looking at the big picture. And when you look at what a private equity firm would want to buy this company at, it's definitely more than $300 million. So I think that Ascena's real value will be reflected in the stock price due to their change for growth plan and due to some other very positive signs. And here's a summary: like they got a new operating model, they're closing unprofitable stores, and they're streamlining efficiencies. They've got very good growth in their digital channel and e-commerce channel, and the management's interests are aligned, and they got an enormous share buyback plan, and the bear case on the stock is very poor. So let's go into some details. So the write-offs, the write-offs that came out in Q3 2017, they wrote off $1.3 billion of intangible assets and goodwill. So these appear in the income statement, right? So this drove like the fiscal year revenue down to like negative $1 billion, and it hammered the stock down 56% to the $2 region. And I think it was irrational selling, because when you look at what basically writing off what intangible assets are, like the loss it's just a paper loss. It's not like someone charged the company with $1.3 billion in cash. And I think investors took this like Amelia Bedelia literal, and they're like, as you can see in the cartoon, they were like, oh, a billion is 1,000 million, and so we should get out.
Mm-hmm.
So, and there's a cool story behind these write-offs. So most of these write-offs, they came from Ann Taylor and Loft. So if you look at page 73 of Ascena's 2017 10K, you can see that Ann Inc. had wrote up their goodwill and intangible values aggressively before the acquisition was completed. So they marked up their intangible assets values before the acquisition to a value that was above the fair value of their intangible assets. And I believe that the write-downs by Ascena was actually a disciplined action to put a fair value on their intangible assets and goodwill. So the new operating model. So before there was David Jaff, the CEO, and under him there were like other CEOs for all the other brands, which was quite an inefficient structure, and there was no such focus on the online service, the e-commerce part of the business. There was like no focus on that. No one was responsible for that. And the new management structure is basically that you've got David Jaff, and under him there's one CEO for all Ascena brands, and this ensures centralized control. And then we have a person who is like actually responsible for the online services, the e-commerce thing, right? So we'll see in the next slides how it has performed in the e-commerce business. All right, so it has been streamlining efficiencies. It's been closing stores that are unprofitable and that create very low cash. Now, many investors would also take that as like a very bad thing, because they're closing stores. Oh, this company is bad, they're losing their customers and this and that. But if you look at a recent company, if you look at Kohl's, Kohls, that company, like they started closing stores, and because they had a lot of stores in one location, and it's the same with Ascena. So they closed some of the stores, and the sales didn't get hurt by that. And I think Ascena is the same, and the sales from the stores that are going to be closed will be either transferred to the e-commerce or the e-commerce part of the business, or maybe the store, like they got a lot of stores in one location, right? So they'll be transferred to the few stores. All right, so the cost synergies program is expected to lead to like $250 to $300 million in annual cost savings by 2020. And let's see. All right, so the company has, like, most of the analysts who are bearish on the stock are like, this company is a dinosaur, and it doesn't like the internet and everything. But if you look at the growth in online transactions, it is very good. Like when you see this, like they have been somewhat successful in attracting online traffic, And I think internet won't be a headwind in the future because they'll be a part of it. And it also shows that Ascena is embracing the internet and it's not fighting it. All right, so management is incentivized by a turnaround. Like the management here is like they own options. They own about like 16 million securities that'll be issued at around $11 a share. Like that's the exercise price. Now their options are all worthless. So the stock right now is at $2 a share. The exercise price of their investors' compensation is $11 a share, which means that they'll do anything to turn this, like they won't take bad steps, but you know they would really try to turn this company around so that they can get their options in the money and they could take their bonuses and everything. So the management's interests are aligned. All right, so we got a very huge buyback opportunity here because if you hear the last earnings call, Ascena planned to repatriate about $200 million this quarter. And when the CFO was asked about the use of this funds, he stated that they were looking at a buyback opportunity. So Ascena's market capitalization is around $400 million right now, and the management has a repurchasing authorization of $180 million, and they can literally buy like half of their outstanding shares at a highly discounted price. So this can also serve as a short-term catalyst, and the buyback could bid the stock up to like $4, $5, $6 a share. So if a buyback is not what they do, they'll certainly use the money to pay off the debt. So it's a win-win situation. Like either they'll have a more balanced capital structure or the stock price goes up. All right, so the bear case on the stock is very poor. So an argument, they're like very poor arguments. Even though the short interest in the stock is like very high, the arguments don't make sense. Like if you look at some of the bearish analysts, they're like, the company has lots of debt. And I'd argue that like the company has been paying its term loan payments with ease and it's got a lot of cash and the balance sheet is good and everything. It's got fiscal liquidity of $800 million. So the balance sheet, okay, it's not a fortress balance sheet, but it won't be a problem. And another argument is that one of Ascena's online strategies is buying merchandise online and picking that up from the store, and it will ultimately fail and lose most of its customers. And this is a very poor argument because, like, firstly, customers aren't forced to basically pick it up from the store. Like it's just an option, and it is present in only one of Ascena's segment, and it is just being tested. So the bearish analysts are just looking, cherry picking the bad things, and making a doomsday theory about this company. And the last argument that the bears make is that Ascena is fighting the internet instead of embracing it, which is completely inaccurate. As you could see, the online transaction growth that completely bulldozes this argument. So I quote David Jaff, who says, "Retail has transformed, and so must we." So it shows that the company is ready to change. All right. So what else could go?
And can Junior Bear? I just need. Somebody's at my door, and I just need to let him in really quickly. Just bear with me. 2 seconds. No, that's good. No worries. All right, sorry about that. We're good.
No problem. Yeah, so the investment risks, okay, what else could go wrong? Okay, there could be a downturn in the economy, which could like hurt sales badly, primarily in the premium fashion segment, because it's where people pay, it's like the luxury brand of Ascena Retail. So that'll get hurt a lot in a downturn. And then there's the interest rate risk. As I told you before, they took out a variable rate term loan, and for every 12.5 basis point increase in interest rates, the company will have to book about $1.2 million of more interest expenses. And then there's an acquisition risk, and this is a risk to the thesis. I mean, although it is very unlikely, and if it does take place, the premium will be very high because, as you saw, the strike price of the options was like $11, and definitely if David Jaff wants to sell the company, he'd want to walk out with some, in the money options, right? So, okay, so a quick summary. They got a strong brand, a new operating model, closing unprofitable stores, and their growth in the e-commerce channel and management's interests that are aligned, and enormous share buyback plan, a very poor bear case on the stock, and the misunderstandings in the write-offs. So I think that the change for growth plan will basically turn around the company to its former glory, and I think and I've assumed that the company will grow its revenue at about 2% annually, and by 2023, it'll make about $7.2 billion in revenue, and it will achieve its peers' profitability margin of about 4.5%, which is around $327 million. And I'll put a PE ratio of 10, which is quite conservative considering that the average peer trades at around 15 times PE. And I've estimated the value of Ascena in 2023 at $3.2 billion, and the share price target in 2023 is $16.70, which is quite a big upside from where it's today. So I believe Ascena is trading for pennies on the dollar, and I think it's a buy. Thank you.
Excellent. Yeah, Faizan, thank you for that. That's a great presentation. While we're on this evaluation slide, walk me through the growth. What kind of annualized growth is that to get us from today to your 2023 revenue estimate?
Oh, so it's like 2% annual growth in the top line revenue.
Okay, so pretty manageable.
Yeah.
And then net income, what does that end up? What's the growth on the net income?
The net income right now is negative. The company doesn't make a profit
Right.
now.
Was that mostly because of the write-off, or was that if you adjust for the write-off, would they have been positive?
Yeah. I think the write-off has put the company under a lot of scrutiny, and I think that was one of the problems. But there's other problems too, like the e-commerce headwinds before, and I think gradually it is turning into profitability as the company is guiding towards Q3 2018 estimates of about it's breaking even. The estimates are that they'll break even.
Okay. Excellent.
Yeah.
So when you talk retail, retail has definitely been under pressure as a category.
Yeah.
The 800-pound gorilla in the room is Amazon, right? Is killing, how much of a threat is Amazon? What's the competitive landscape for Ascena, and, who do you worry about in that space?
Yeah, so I think Amazon would be a company to worry about, but there's also other companies that are trying to enter, like, for example, the plus size market, where, they're doing their best to, attract customers, and, they could take out Ascena's main loyal customers, and, it could hurt the company. Yeah.
Okay. And then, so you you addressed this a little bit. Clearly the market is pricing them to, basically near bankruptcy. You're right. You really find a company that's trading below cash value, right? Yeah. So the market clearly thinks they're going to go bankrupt. The market, what do you think? The market just doesn't believe the turnaround plan
Yeah. So look, it's the environment's like this. Like, investors are they just want to be into the growth stocks, and the companies that are involved in the internet and Amazon and this and that, the buzzwordy stocks, the cool kid stocks. They want to be in that company. So as for now, I think they just don't look. They just don't think there's something interesting in this company because it doesn't have one of those buzzwordy things. But the bottom line is profitability and revenue, and if you look at this company, it's making a good amount of money.
Yeah. So my last question is, shoot, I should have written it down. Bear with me. It's been a longer day. Shoot, it was a good one too. Do you mind flipping through your flip back
sure.
to your presentation? I think it'll jog. Yes, here we go. Okay. So, as in your research, if you come across, a sense for how much they're investing in their online presence, is that where, they expect a lot of growth to come from, in the future, or is it, same store? Where's the balance?
Okay, so like the e-commerce business, the e-commerce arm will definitely be a part of the business, but I think like it won't be like the bread and butter of the business. It'll definitely be a part of it, but the main source of revenue will always be the brick and mortar retail stores. And I don't think that it will be like most of the company's sales. It'll definitely be a part of it. It'll give customers a chance to like go online and buy their stuff if they want to buy. And but I think their main source of the revenue will always be like the outlets and the stores.
Okay. How much are they playing catch up to their competitors on the online? Are they kind of on par-ish? Or do
I'm
they
not
still
sure
have more?
about that, but the growth shows that like they're definitely improving a lot.
Yeah. Excellent. Well,
Thank
Faizan, great presentation.
Thank you. Thank you.
So, Christine, should we, how do you want to do this from here? Do you want me to, obviously the Caroline and Kaylin are off. Should I just kind of think about this a little bit and then we can come back to them with feedback in the next couple of days?
Sure, or we can just email them.
Yeah.
Mhm.
Yeah. Perfect. Okay.
All right.
I'm very grateful that I got the opportunity to talk about.
Good morning. All right.